Okay, let's set the scene properly for this one. It is February 2026. The dust is finally settling on the fourth quarter of 2025, and Occidental Petroleum OXY just dropped the results.
Right.
And look, if you are just glancing at the headlines on your terminal or your news feed, you might see oil company reports earnings. Maybe you spot this kind of confusing net loss number, and you just scroll right past it. It looks like totally business as normal in the oil patch.
But if you are a long-term shareholder, or frankly, if you're just anyone who's interested in how capital allocation actually works in the energy sector, scrolling past this report would be a massive mistake.
Yeah.
Because beneath the surface noise of this quarter, something fundamental has shifted in how this machine operates.
And that is exactly our mission for this deep dive today.
Yeah.
We are stripping away all that day trading noise.
Yeah.
We aren't here to guess what the stock price is going to do tomorrow morning at the bell.
Right, no crystal balls here.
Exactly. We are looking at OXY entirely through the lens of business durability and a 10-year horizon. So for you listening, we've gone through the Q4 2025 transcript, the full slide deck, and those strategic outlook reports that were released on February 19th. And I have to say, looking at the raw data, there are some genuine surprises in here.
There really are, and I think most of them revolve around a word that gets thrown around a lot in corporate America, but rarely actually means anything tangible.
Efficiency.
Efficiency. Yeah, we talk about discipline in the oil sector all the time, but OXY is putting up numbers in this report that redefine what capital efficiency actually looks like physically in the ground.
So let's get right into the scorecard then. We need to weigh the positives against the negatives because, it wasn't a perfect sheet of all green arrows. But let's start with the good news, because some of these headline numbers are massive.
They are. I mean, the headline that grabs you immediately is the production. OXY hit a new annual record. For the fourth quarter of 2025, their worldwide production came in at 1,481,000 barrels of oil equivalent per day.
That is 1,481 ambode for those of you taking notes at home.
Exactly.
And just to put that into context for a second, that actually beat the high end of their own guidance. So despite everything going on in the macro environment, they are pumping more out of the ground than they promised they would.
They are. But for me, the production number is, well, it's vanity. The sanity is in the balance sheet.
Oh, the balance sheet.
Yeah, this has been the absolute elephant in the room for OXY ever since that massive Anadarko acquisition years ago.
Right.
We've been watching them chip away at that debt pile for what feels like forever. Well, in Q4 2025, they did way more than chip away. Principal debt is now down to approximately $15.0 billion.
Which is a $5.8 billion drop in a very short window.
Right, mostly helped by the proceeds from the OxyChem sale.
$15 billion. I mean, I remember when that number was terrifyingly higher, closer to, $40 billion at the peak?
It was a stranglehold on the entire company, and now it's manageable. And the thing is, they aren't even stopping there. They're using the remaining proceeds from that OxyChem divestiture to push the debt down even further. They are targeting roughly $14.3 billion shortly.
So this is a company that has essentially fixed the biggest glaring flaw on its balance sheet.
Yes. And because they aren't paying those massive, crushing interest payments anymore, they actually increased the dividend by more than 8% to 26 cents per share.
Okay, so record production, the debt is no longer an existential threat, and they are paying you more just to hold the stock. That sounds phenomenal. But there's one other metric in the good column that I don't think we can skip over. Reserves.
Ah, yes. The organic reserves replacement ratio.
Can you define that for us real quick?
Sure,
Because
yeah.
I feel like that metric gets buried in the footnotes. But if you're a long-term holder, it's basically everything.
Sure. So think of an oil company like a grocery store. Every single day, you sell inventory off the shelves. That is your daily production. If you don't find a way to restock those shelves, eventually you have nothing left to sell and you go out of business.
Right, you're just liquidating yourself.
Exactly. So the reserves replacement ratio measures how much new inventory you found compared to what you sold during that period. And OXY hit a 107% organic reserves replacement ratio.
Meaning they found 7% more oil than they actually pumped out of the ground.
Precisely. If you are holding this stock for a decade, that is the single metric that tells you the business is sustainable. They are actively growing the store's inventory, not shrinking it.
Okay, that is an impressive highlight reel. But we have to be honest with everyone about the ugly parts of the report.
Yeah.
Because if you looked at the literal bottom line for Q4, you saw red ink.
You did.
A reported net loss of $68 million. That is negative 7 cents a share.
I can already hear the bears jumping on this, saying, they pumped record oil and still managed to lose money. What exactly happened there?
This is where you really have to separate headline numbers from accounting reality.
Mm-hmm.
That loss was not because the wells stopped pumping or because their operating costs suddenly blew out of control.
Okay.
It was almost entirely driven by transaction charges associated with that massive $9.7 billion OxyChem divestiture we just mentioned, plus some somewhat lower realized commodity prices during the quarter.
So it's basically just paperwork costs dragging it down.
Essentially, yes. If you look at the adjusted income, which strips out those one-time transaction costs, they were actually profitable to the tune of $315 million.
Got it.
So the core business is absolutely making money. The accounting for the chemical sale just made the quarter look messy on paper. Okay, fair enough. But it wasn't just accounting noise. There were some operational red flags in the guidance too, right? I noticed they cut the exploration budget.
They did. They've cut the exploration budget by about $100 million. Now, usually you want to see the exploration budget maintained or growing to find that future oil. And they also explicitly mention that the midstream segment, that's the pipelines and processing plants, is going to see lower earnings in 2026.
Why is midstream taking a hit?
The opportunities to optimize gas transport just aren't as plentiful right now as they were previously. The spreads, which is the difference in price between one physical location and another, have tightened up significantly.
Oh.
So that quote-unquote easy money from simply moving gas around the map to capture those price differences, that's drying up a bit.
Okay, so midstream is cooling off, exploration is down a bit. But let's pivot to what I think is the most absolutely fascinating part of this entire report. Segment 2, the efficiency engine. Because when I was looking at the 2026 capital budget, I legitimately had to double-check my own math. It just didn't seem to line up with the production guidance.
It completely catches you off guard, doesn't it? It defies the usual industry logic of, having to spend more to get more.
It really does. So let's look at the numbers. The budget for 2026 is set between $5.5 and $5.9 billion. The midpoint there is $5.7 billion. That is roughly an 8% reduction from their 2025 spend. They're cutting their capital spending.
Right.
And here is the massive, but they still plan to maintain that huge production level of around 1.45 million barrels per day.
Mm.
They are spending significantly less money to get the exact same amount of oil out of the ground.
Yeah.
Usually, especially in shale, if you cut your spending, production drops like a rock. How is OXY defying gravity here?
This is the real aha moment of the report. If you recall, looking back at the commentary from the previous quarter, the overarching narrative was that OXY would need to reallocate about $400 million into their U.S. onshore operations just to keep things steady. Everyone on Wall Street expected the spend to go up.
But instead, it went down.
Drastically. They actually reduced U.S. onshore capital by $400 million compared to 2025. And the reason isn't because they're just arbitrarily drilling fewer wells to save cash. It is pure ground-level productivity.
Okay, unpack that.
The new well performance, specifically a metric they track called cumulative oil per foot over the first 6 months, is up between 15 and 26%.
Wait, let's break down cumulative oil per foot. What does that physically mean in the field?
So imagine you are drilling a horizontal well through the rock underground. For every single foot of rock they drill and frack, they are getting up to 26% more oil flowing out of it than they did just a year or two ago. They've figured out better ways to fracture the rock, better ways to prop those fractures open, better ways to steer the drill bit itself.
So they literally do not need to spend the money to get the growth.
Mm-hmm.
They're getting more juice from the exact same orange.
That's a great way to put it. They are still expecting 1% growth in that U.S. onshore segment, but they are doing it with a considerably smaller checkbook. The CEO actually called this their saving process for oil and gas.
Yeah.
When you tally it all up, the drilling efficiencies, the better supply chain management, the logistics they have, generated structural cost savings of about $2.5 billion annually compared to where they were in 2023.
That is a staggering number. $2.5 billion a year in savings.
Yeah.
That is pure margin. It really sounds like they've turned kind of boring engineering efficiency into a competitive superpower.
Boring is beautiful applies perfectly here. And this efficiency is what actually unlocks their capital allocation strategy, which is where the long-term investor really needs to pay attention. Because if you don't understand where the cash is going, you really don't understand the stock.
Let's dive right into that then. The 2026 capital plan. You highlighted a specific number in the slides that I think is arguably the most important number for anyone holding this stock. They call it sustaining capital.
Yes. This is the bedrock metric. If you forget everything else we talk about today, remember this. OXY explicitly stated that their sustaining capital, which is the amount of money required just to keep production totally flat at that 1.45 million barrels, is exactly $4.1 billion.
$4.1 billion. Why is that specific number so critical for us to know?
Think about it as the rent the company has to pay just to stay in business. If they spend $4.1 billion, they stay the exact same size. Everything they generate above that $4.1 billion plus the dividend payments is effectively free cash flow.
Right.
That free cash flow is the playground. That's the money for share buybacks, for aggressive debt paydown, or for acquisitions.
And that basically gives them a huge safety margin if oil prices crash, right? Because they don't need $80 oil to survive. They barely need $50 oil to sustain the business because their rent is so remarkably low.
Precisely. But here is the really interesting part about the 2026 plan. They aren't just spending the minimum rent. Their total budget is about $5.7 billion.
Yeah, the midpoint.
Right. So they are spending about $1.6 billion above that sustaining level. The critical question for a shareholder is, where's that extra money going?
Well, looking at the breakdown they provided, the lion's share, about 70% of the total oil and gas capital, is still going to U.S. onshore. That's the cash cow. That's the Permian Basin. But there is a very deliberate strategic pivot happening with the rest of the money. They are moving capital toward what they call mid-cycle projects.
Which is a fancy industry term for projects that take a little longer to pay off initially, but last much longer. We are talking about the Gulf of America, enhanced oil recovery, or EOR, and their international assets.
Why pivot there? Why not just dump every single extra dollar into the Permian, where the payback is almost instant?
Because the management team is playing 3D chess here. They were very clear about why they are doing this allocation shift. They aren't just chasing barrels for the sake of hitting a quarterly production target. The stated goal is to, quote, reduce future sustaining capital requirements.
So they're actively spending money right now on these longer-term projects so that the business actually becomes even cheaper to run 5 years down the line.
Exactly. You have to think about the physical reality of the assets. U.S. shale is very fast. You drill it, it flows like an absolute fire hose for the first year, and then it declines very quickly. You constantly have to keep drilling new wells just to replace the ones that are naturally declining. It's a very fast treadmill.
You stop running, you fall off.
Right. But mid-cycle projects like the Deepwater Gulf of America or enhanced oil recovery, those are fundamentally different. They're definitely more expensive upfront to get going. But once they are on, they produce steadily for years, sometimes decades, with very shallow decline rates.
Yeah.
It's a slow walk compared to the shale treadmill. So by building up that base of slow barrels now, they actually lower the overall speed of the treadmill for the entire company. They simply won't have to run as fast just to stay in the same place in 2030.
That is really smart. It's playing the long game versus the quarterly Wall Street game. And speaking of the long game, we have to address the other massive elephant in the room that usually dominates OXY headlines. Low carbon ventures,
Yeah.
LCV,
These are
direct air capture. We've heard so much about it over the last few years. Is that graining the budget right now?
Surprisingly, no. That spending is actually winding down for them on it. It's projected at only about $200 million for all of 2026.
That seems really low given all the hype and the press releases.
It's because the big marquee project, the Stratos facility, is finishing construction. The heavy, capital-intensive phase is ending. They are completing the project, getting it running, but it's not graining the core budget this year. They are letting the actual science and operations prove themselves out before they dump billions more into it.
Okay, so let's synthesize this capital stance. We've got a lean budget, a very clear focus on lowering future costs by investing in slower decline assets, and a massive margin of safety with that low sustaining capital requirement. This really brings us to the broader strategic evolution of the company.
Yeah.
We talked earlier about the debt hitting that $15 billion mark.
Yeah.
But the CFO threw out a new number on the call that really caught my eye regarding their future debt targets.
You mean the $10 billion target?
Yeah, They just barely hit the 15 billion goal they've been talking about for years. And almost immediately they say, actually, we'd like to be at 10 billion down the road. That feels pretty aggressive, doesn't it?
It does, but it's important to note there is no strict timeline attached to that 10 billion number. They aren't going to starve the core business of capital just to get there tomorrow. But it absolutely signals extreme conservatism. They want to build a true fortress balance sheet that can withstand almost any sort of commodity crash. They essentially want to be bulletproof.
And then there's the other side of the balance sheet, the preferred equity. This is the expensive capital. It costs them a huge amount in dividends every year. Everyone always asks on these calls, when are you finally buying it back?
And we finally got a very clear, concrete date, August 2029.
That is 3 years away from now. That feels like a total lifetime in the oil market. Why wait so long?
It comes down to the fine print of the original deal. Management explained that they are not rushing to redeem this because in August 2029, two very important financial triggers happen. First, the preferred equity becomes callable without the penalty. Currently, there is a 10% premium they'd be forced to pay to buy it back right now.
Okay, so just by waiting, they save 10% right off the top.
Right. And second, and this is the really big one, they avoid what's called the return of capital trigger. Right now, if they redeem those shares early, they are contractually forced to pay an extra $4 per share premium. It is a massive, massive penalty clause.
Wow. So if they aggressively paid it off right now just to appease impatient investors, they'd basically be lighting hundreds of millions of dollars on fire just to say they did it.
Exactly. It makes absolutely zero financial sense. It is objectively cheaper to just pay the high dividend and wait out the clock. So they've established a very clear, rigid hierarchy for their cash flow in 2026. Step 1, maintain production. Step 2, grow the common dividend. Step 3, pay debt down to that 14.3 billion mark. Step 4, share repurchases, but only opportunistically. They aren't just blindly buying at any price. And step 5, patience. Wait on the preferreds until 2029.
It is incredibly disciplined. It's almost boringly disciplined. But then you zoom out, and this is where the conversation gets a little scary, to be honest. We're moving to segment 5, the macro view. Because the CEO made some comments about the broader competition and the state of the global oil industry that really put OXY's conservative position into a stark perspective.
This is the macro context that matters most for a long-term holder. The CEO highlighted a statistic that, frankly, should keep energy policymakers awake at night. The industry-wide reserve replacement ratio right now is currently less than 25%.
Less than 25%. Let me make sure I'm understanding the math on that. For every 4 barrels the global industry pumps out of the ground to sell, they're only finding 1 new barrel to replace it.
That is exactly what it means. We are collectively draining the global tank. And remember, the world burns about 30 billion barrels of oil every single year. We constantly hear about these massive, exciting discoveries in places like Namibia or Guyana, and OXY even has a block in Guyana. But the CEO pointed out that even a massive generational find like 12 billion barrels barely covers a third of 1 year of global demand.
That really puts it in perspective. Because we think we're swimming in oil right now because daily production is so high, but we are actually burning through the geological savings account at a rate that just isn't sustainable.
And that reality leads straight to their major prediction. They see a significant supply crunch coming by 2027, a market rebalancing where supply simply cannot keep up with baseline demand, all because the broader industry hasn't invested enough capital in exploration over the last 5 years.
And this is where OXY's specific strategy starts to look pretty brilliant. While the rest of the industry is running on fumes with a 25% replacement ratio, OXY is sitting there with a 107% replacement ratio and a 30-plus year inventory runway.
They're essentially hoarding high-quality resources while everyone else runs their cupboards bare. They have the inventory in the ground to sell into that 2027 supply crunch, while their competitors might be scrambling just to find decent rock to drill.
It's basically a contrarian bet on durability. And there was one little personnel note in the report that I think perfectly reinforces this operations first mindset they have right now. Babatunde Cole is taking over investor relations.
Yes, and that is not your typical hire for a head of IR role. Usually you get a finance person, maybe an ex-banker, someone who speaks Wall Street lingo fluently.
Right, the typical suit.
Yeah. But Babatunde is an operations guy. He was the VP of the Delaware Basin Unit. He is literally the guy who helped deliver that 15 to 26% well improvement we were talking about earlier.
So they are putting the actual engineer in front of the Wall Street investors.
Exactly. Putting him in front of the analysts tells me that OXY wants the corporate story to be about operational grit, about the rocks, about the physical efficiency, not just financial engineering tricks. They want someone at the podium who can explain exactly how they're getting that oil out of the ground so cheaply.
So let's wrap this up. We started this deep dive by asking if this was just another standard earnings call or a fundamental shift for the company. To me, it really looks like OXY has entered an entirely new phase.
I'd call it the boring is beautiful phase, but boring in the best possible way for a shareholder. They have slashed the budget, but they've increased efficiency so much that they aren't even losing growth. They have decimated the debt pile, and they have a highly deliberate, patient plan for handling that preferred equity.
It's a machine,
Mhm.
a high-efficiency, cash-generating machine.
It really is. And I actually want to leave you, the listener, with a final thought to chew on. We just discussed how the broader industry is replacing only 25% of what it produces. We know a supply crunch is likely hitting in 2027. Yet OXY has decided to cut their growth capital right now in 2026 to focus purely on efficiency.
Which, on the surface, seems totally counterintuitive. If a shortage is coming and prices are going up, shouldn't you drill more right now?
It does seem backwards at first glance, but ask yourself this. Is OXY's decision to spend less now actually the ultimate long-term bet? By preserving their prime inventory, keeping those valuable barrels in the ground today when prices are just moderate, are they intentionally positioning themselves to unleash that 30-year runway exactly when the rest of the world runs dry in 2027? They aren't just saving money right now. They might be saving their ammunition for the exact moment it's worth the most.
That is a fascinating way to look at it. It's not just engineering efficiency, it's inventory management on a global macroeconomic scale. They are waiting for the ultimate price signal.
Yeah.
Well, on that note, we are going to sign off. Take a look at your own portfolio allocations today and ask yourself if you have enough sustaining capital in your own strategy to survive the inevitable volatility. Thanks for joining us for this deep dive.
See you next time.